There's a long value chain in ETFs that goes from the provider through the intermediaries to the end client. So I want each of you to tell us about what your role is in that value chain. Carmen, why don't you start?
Sure. I look after the strategy and around our ETF range. It's all our passive equity offering, actually, and ETFs are part of it. And we decide what products are going to be launched, but also, which indices we choose, what allocations we're looking for, but then also which is going to be the strategy to sell them, how we're going to price them. And then I obviously support our salespeople in when they go and see clients as to how to position and how they fit, how we can find solutions for our clients. Sorry. Finally, I also look after the capital markets function also falls under my areas. So that's the secondary market.
Thomas, do you want to, is this microphone going to work, or do you want to hold the stick mic?
Yeah, let's.
Got it, okay.
Yeah.
So go ahead and tell us what's your role in the, if you want to use the mic.
I'm looking for the pan-European business, and that means that we're engaging with a ever-growing crowd of clients and prospects who actually want to use those products. And I think my job in the whole value chain is really to bring knowledge and explain those products in details. And I agree with you. There's a whole range of value chain steps which as a user you have to understand to fully get the benefit out of these products.
All right, Frank.
Yeah, we are Commerzbank. We are a large market maker in Europe and sitting in between the market, so the clients which use ETFs, and on the other hand, the issuers which bring the ETFs into the market. So we are part of the ETF ecosystem.
All right, so let's talk first of all about, Carmen, why don't we start with the SLIM index, or the SLIM ETF, which tracks the Solactive index. I mean, what kind of products do you think are the most important to deliver to clients, and especially for you at HSBC, what kind of products do you find the most useful?
Sure. Let's see if this works. I actually quite like the idea of the SLIM ETF, and I had to smile a lot. Yesterday we were at Fund Forum, and there was an ETF special day where, again, these type of ETFs were discussed. And I have to say, obviously as a provider, but also as an industry participant, I think there's certain themes or certain products which are perfect as an ETFs, and some of them which might have a shorter term horizon, or which might be too thematic in nature for ETFs. So from an HSBC perspective, what we're looking at is market access. We're strong in emerging markets, so the China theme is fantastic for us. We love it. This is where we can show our expertise, where we can offer special products to our clients. Saudi Arabia is another one. So these market access products we think are very interesting. But also when it comes to, if you look at your, God, I hope I can make this work. If you look at your equity allocation, the other thing that we think is particularly interesting is obviously the market cap space is the core market cap space in particular is already very well represented. So we think where the innovation and the growth is going to come from is actually from the other parts of your allocation, something that we call active systematic, that some clients might call smart beta. And then there is a third part also, rather than measuring market cap within that, you're looking at SRI. How are you looking at your responsible investing? How can you incorporate that into your portfolio? So we're looking at different solutions within that equity allocation, how you want to go beyond just a standard market capitalization and look at your risk-adjusted return, but also put some tilts in.
So, Thomas, do you think we're looking at the right products now, and that clients know how to use them, that the end user knows how to use them, access them, and use them right in his or her portfolio?
I would like to differentiate your question a bit. If you talk about client, what we're talking about, right?
Yeah.
It really depends. I think that's a common theme running through the whole debate and discussion in this industry. We always talk about the client, but the client can look very different. You started saying, the client could be a very sophisticated, institutional client who has totally different needs. Quick equitizing cash, doing some tactical allocation shifts, getting maybe exposure to a certain asset class where he thinks, I don't want to, give that to a third manager, but I don't have the expertise in-house, so let's use an ETF, right? And I think that's, by the way, a new development where very big asset pools tipped into the expertise of ETFs, which has never done that. Big pension funds, but also central banks have started using ETFs, which is new. The original usage of ETFs was, for years, actually the asset allocators, the portfolio managers themselves, so active managers who used ETFs to quickly adapt their allocation, to make sure they were invested in the market, which were sophisticated or which are sophisticated investors. What I think, and that's where Vanguard also wants to really play a part in Europe, is to bring that investment solution to a more broader base of clients. So, intermediated retail clients, clients who normally do not have access to such an instrument, and through ETFs, and that's what Sean meant by it's a democratization process ongoing. And probably to your point, yes, we come slowly but surely to a tipping point where the broader mass actually gets access to these great instruments, which I think, bringing back to the SLIM proposal, which I have a different view on. I'm not sure whether somebody, a retail client who wants to save for his retirement really wants to take these kind of very slim bets.
No, it's for punters. I mean, well, maybe not for punters, but it's, I would say, for someone who's developed a different strategy and has, a theory on what's going on. I mean, we can all say that people are getting fatter around the world, right? And it's started in the U.S., it's coming through Europe, and it's definitely headed to China as well. What do you think about the clients that you're selling to? It's exciting to hear that central banks are starting to be buyers of ETFs. You would have expected pension funds to make that decision because they can keep, obviously, the cost down. Are those lower costs going to everybody or just to the first group of people you're selling to and then getting raised throughout the value chain?
Meanwhile, it's going really to everybody. I mean, it is really a fantastic space at the moment. A retail investor has the same, let's say, access to a market like an institutional client. There's not a big difference. They get the same spreads, and if they make that due diligence, and also Sean mentioned that before, it is important to make this due diligence. As a retail investor, you have the same access like an institutional client. And that is perfect, that's great. For us as a market maker, we like the variety of products, for sure, as long as we can trade them. If we can trade them and have access to the underlying, it's all fine. If that is a problem and we don't have the access to the underlying, or maybe not the access to the portfolio, then it will be getting difficult for us as a market maker, and I don't like that. At the moment, we really need to push these products into the wide market, broad market, and therefore...
Well, how often is that a problem? I mean, liquidity has been an issue surrounding ETFs for a while now. Do you feel...
It's not an issue. Liquidity is definitely not an issue. It is an issue driven by the press, by the, especially here in Europe, because you have this fragmented market here in Europe, and you see only the liquidity, or the, let's say, what is shown on screen in the market, but that's not the real liquidity. And we have to explain that there's much, much more behind, and as long as the underlying is liquid, you always get a price for an ETF. And that is a task also for us as a market maker, but also a task for the capital markets team of the issuers to explain that to the public. And coming back to the clients, institutional clients, yes, started using ETFs 10 years ago, 15 years ago, but now we are seeing clearly that the retail market is stepping in. Our number of trades increased dramatically over the years, and I have a statistic since 2011 already, where we started with 2,000-3,000 trades per week in ETFs. Now we are reaching 50,000-60,000 trades per week in ETFs, and that's not only institutional, that's retail. So retail is already there and it's using ETFs.
Just want to add one little point on the statistics I just read about the Jaruli report 2019, which showed that, 82% of their surveyed, answers actually expect a a massive or a moderate growth in ETFs in the retail space, right? And I think that's the news, and that's what you see on your trades, that more and more through model portfolios, through Sparpläne in Germany, they're actually being used as core building blocks, which is something new. And I think that's where in the US, to your reference, in the US, ETFs become big because they were used in very well-balanced core portfolios as building blocks, as their preferred choice of building blocks, getting access, very cost-efficient access to. I think that's where we just entered this area in Europe now.
But, I mean, of course, how could they not be, right? Coming from the U.S., you know, I grew up listening to Jack Bogle talk about this kind of stuff. So, you know, there's a whole generation of people out there, or maybe 2 or 3 generations, considering how old Jack got to be, that, you know, think of index investing as the way that the average retail investor saves money, and even a way that the retail investor can beat the, you know, masters of the universe on Wall Street who are always pushing for active trading. Do you find yourself creating a lot more products and talking to that trend of, I don't want to get into the active versus passive debate, but this is a way for people to basically track these core indexes at low costs?
I think I would 100% agree. This is where a large part of the growth is coming from in this space, and when you look at the model portfolios that are being built, obviously when you are a retail investor, you don't want all model portfolios to be exactly the same. So as a provider, what's important for us is that there are some distinguishing features even within that fulfillment. Although you're offering core, what type of core are you offering? What type of features do you have within that core? But then also coming back to what I was saying a bit earlier, I also think just using market capitalization indices over the long term, what we're finding is that the model portfolios are changing and they're adapting and they're looking as to where are my return sources coming from? Do I need to incorporate some factors? And I think this is, I sort of feel that I have Frank in the background. Of course, this needs to be done within a transparent framework that we can offer these type of products. But I still believe that this is where the growth in the industry is going to come from in the long term, that we're looking beyond what is market cap. We are looking at market cap and, of course, what features it needs to have. You know, are you happy to have your securities lending? Are there other characteristic stocks that you want to have out of them? That's fine. But I think just tracking a market cap index, just tracking the market with a very low tracking error, I think for a lot of portfolios it's not enough. And I believe as the retail investor or this intermediated retail gets more sophisticated, they will start to understand, they will start to demand something which goes a bit beyond that and which looks much more like a portfolio construction we might be used to from more sophisticated investors.
So does it make a difference to you, Frank? I mean, if you're trading just these core index baskets compared to the smart beta factoring ETFs, is it more difficult?
I mean, of course, it's more difficult, the smart beta ones, but it is not such a big problem for us. As long as we have access to the underlying, as long as we have access to the portfolio construction, then it's all fine. It's at the end, it's technology. Of course.
But you keep saying as long as you have that access. Is that because there are times when you doubt that you may have that access? Is there times when that transparency isn't there, or?
I mean, we talk about developments and innovation, and at the moment we have an ETF. For me, I'm a purist in ETFs. Everybody really needs to know what is in the portfolio and has access to this underlying. If you don't have that and only a few people have access to that, then I get a problem personally by myself. But as long as we have this access and everybody has access to how this product is constructed, then it's fine and we can trade these products. So that's clear. But of course, an S&P is easier to trade than a smart beta.
Thomas, do you see? I mean, is this becoming an issue? Because as Frank said, the press does notice these kind of things, and maybe the press occasionally blows things out of proportion once in a while to sell papers, you know. But, I mean, there have been issues, certainly in the mutual fund industry lately in the UK, that have freaked a lot of people out. Is that kind of thing even possible in the ETF space? I mean, you can't really, no one's going to close gates and say you can't take your money out of an ETF.
I think that brings me back to a point also Sean kind of noted at the beginning. it is in any investment instrument, in anything you buy, you better understand what you buy. If you buy a car, it's better to understand how it's built, where it's built. Is it a diesel? Is it a normal standard? Is it something else? I think that's no different here, and that's always a bit where we, as Vanguard, also a bit concerned, is if it's just too quick to say, it's an ETF, it's good, it's simple, I understand, it's cheap, right? No, it's not true. You have to do due diligence, you have to understand the instrument. I think that's where we really, as an issuer, but also as the entire ecosystem, Frank said it as well, we need to educate people. I think you brought up Jack Dogle. What did he do? He explained the fundamental mechanics and explained why, for example, indexing, just plain vanilla, broad market cap, is actually quite a reliable strategy and has some very good benefits. But even then, you have to understand, what is a broad index? Is the slim a broad index? Is it a way of capturing a certain beta, a risk source for equity premium, right, or not? So then you go very quickly into quite complex topics, which, by the way, are still debated in academia. It's not so straightforward. It's not a natural science. It's an art. And I think that's where we are at the moment. That's why we're doing also this debate here now on the stage, because we need to explain and we need to view it from different angles. I think that puzzles then a picture together. And I think to ask end investors, intermediate retail investors, to understand within 5 years, let's leave it at 10 years, a new innovative instrument like ETF, it's not so easy, right? I think in many, many ways, and that brings me just back to the argument, can it happen in ETF? In many, many ways, ETFs are structurally funds. It's a mutual fund. It's a UCITS mutual fund with some additional features, which includes the trading. So you have to understand not only the mutual fund structure, how do you unwind such a structure, who is regulating such a structure, what's allowed, what's not allowed, right? What's in the prospectus. You have to understand this. And I think you can read it and you can understand it. It's not so difficult, but you have to do it. And then the other side, 50% of the ETF is trading. It has its own kind of characteristics. You have to understand, how can I put an order with Frank, right? Do they execute in my best interest? What do I do if I have more than 100 euros to trade? Where do I go? Where is liquidity, right? Do I trade, etc.? Is etc. always the best liquid place for this ETF? You come into a whole different world of questions, which I think the best thing is you read up on these things, you ask the issuer, you ask trading houses and ETF desks like Frank's to get your answers. And I think that's what we talk about due diligence, right? You have to do your due diligence regardless whether it's a single stock, which is a bond, which is a mutual fund or an ETF. It's the same due diligence you have to do. You have to understand the instrument. That's my point.
And it certainly is very complicated when you look under the hood, right? I mean, the basic idea of an ETF is pretty simple to grasp. But when you start looking at how they're created, how they're unwound if you need to, it gets incredibly complicated. We haven't had like a long-term capital management. We haven't had a huge blow up in the ETF industry yet. Do you think that we will see one?
Maybe we need to check Google here in Europe to explain that every morning. It's really about education, still education. We are in the market already for many, many years, and we think, okay, we see a mature market, and many investors are here using ETFs for a long, long time, and they're familiar with it. But there are many, many others out which haven't heard about ETFs, and that is our task, all of us, of the whole ecosystem, to explain that to the people. What is an ETF, and how can I grow my assets with ETFs? And that's a major task.
I just want to add a little thing. We did have, actually, in 2008, I remember very well, in the German press as well as on panels, we had the debate versus physical versus synthetic, right? I think that's, for me, it's a good sign, because that was boiling up something which I think is important to understand. Some ETFs are not created the same way. That's fine, by the way, but you have to understand. And what I don't like is if it's not explained to the users of ETF, if it's just pretend that's the same thing. No, it's not. It's fine, but you have to understand what the difference is and do they bear different kind of risks? And I think that was the first time, I think the broader public, even some specialists who do not deal every day with ETFs, but with the financial industry, actually got more into detail. So I have to make a distinguish between physical and synthetic replication. I think to your question, I think that is true for, how does an ETF do securities lending? I think, every user has to understand what is the policy, how do they implement it, because there's a variety of ways you can do that. I think that's with everything, right? How the Menko is run, how you can trade the ETF. That is true. So I think it's understandable, but you have to ask questions. And again, back to your point, education, press needs to help to educate the wider crowd as well as the industry itself.
I would like to add to that point as well, and I think I would agree on the integration part. And for some time, I think a lot of providers we have erred on the side of caution and thought, oh yeah, everybody knows what this is. But clearly, these debates show that there still is enough to talk about. And there is a point that Sean was mentioning earlier about regulation, that to a certain extent there is an invitation, there is a focus from regulators on what is happening here. And I think this is because obviously the industry has grown through substantially. And I think that one point that regulators are particularly worried about, which is liquidity, it is our responsibility as providers, but also our authorized participants as market participants, to make sure that we talk more about liquidity, because what we're finding is that there are a lot of myths around liquidity, and I was quite happy when I was going through the brochure on the seed, and I saw, yes, there is a capital markets brochure within your brochure, which explains quite clearly what to pay attention to. And I think we need to do much more than that. And we need to make sure that in these debates, in the press, we talk much more about what is liquidity, so that these misconceptions are being addressed and they don't lead to some form of regulation, which ultimately could be detrimental for the industry.
Can I just add one little thing with regards to putting things also in perspective, right? Yes, the ETF market has grown. I've seen levels in 2003, which was like not even on the chart, but we have to put things also in perspective. If you compare ETFs usage in portfolios versus the mutual fund usage, right? Like it's tiny. It's 4.5, maybe it's 5%. I know some, banks in their own model portfolios, they use maybe 9-10% ETFs. The rest of the 90% is actually mutual funds or segregated mandates, right? Which, the regulator is not asking any questions about, systemic risk because the assets are so high. So, yes, education is lifting the hood and explaining what's working, how it's working all together, but it's also putting things into perspective. And I read a lot of regulatory text. The recent one just came out, which honestly I have to say, put things into perspective. Do your analysis yourself and then think of it. Is that something really, can it cause any problems or not? The growth rates are mind-boggling. That's fine. But put the things in perspective. And I think that's also a job of an industry.
I want to ask Carmen about the trends right now. I mean, you talk about the smart beta products, factoring. What are the hottest products out there? I mean, what have you had the most success with? What do people want?
Well, I think definitely at the moment it's on the active systematic side where we see a lot of success, but also on the market access. I can't stress enough, and I think this is because of the makeup of our company as well, that when you look at emerging markets, when you look at inclusions such as Saudi, such as China, people will immediately come to a house that is very present there. So this is where we're seeing the success. However, I will also say one of the things that we're monitoring is that there clearly is a more from an investor perspective, I'm not going to call it values, but there is some concern in terms of the risk associated with responsible investing, how are they managing the risks correctly in their portfolio. And I would imagine that over time, this is where a lot of the development is going to focus on as well. And I think we've already seen some of the products come out in the space. I think this is definitely going to accelerate.
Do you see also, An ETF would seem to be a great way for someone to execute a much more difficult trading strategy. For example, if you want to invest in emerging markets, it's not so easy to buy those things as an individual or even institutional investor. So do you see those as your most popularly traded products? Aside from the core sort of plain vanilla index funds that, you know.
Yeah, I mean, it's really, for us, it's really the task really bringing together this fragmented market we have here in Europe and getting that everybody has an access to the market of ETFs. That's really a very important task for us, away from the specific products. That really clients and investors have an access to this market. And you cannot imagine, you see all the exchanges, you have the major exchange here in Frankfurt or in Italy or in London or in Switzerland, wherever, but there are so many other places where people execute ETFs at the moment and bring that all together. That is a major task for us, and this is where I see our place also in the future to open that gate and that everybody has the same access to that market than an institutional investor.
Let me finish on fragmentation, Thomas. I mean, this is an issue, obviously, not just for ETFs, but for the whole industry. It's a very European issue, let's say. Mm-hmm. How do you see that issue getting resolved?
I think it's a difficult task. Starting with different venues to trade, and not only the ones which we all think about, etc., and Borsa and so forth. It's actually the fragmentation in, every market has a little bit of a different preference, right? And obviously requires different kind of additional documents or approvals to actually talk to different type of clients, and different countries have different rules to talk to different clients. So it makes it quite a cumbersome place to kind of roll out this education. However,
do you see consolidation then happening? I mean, in what time frame?
Time frame is difficult, but what I definitely see is, Europe used to be a very distribution market which was very, very captive. So regional players would control to talk to clients, to educate them, and to build portfolios for them, right? I think that's what we're seeing post-RDR, post the ban on retros. I think that's what's really changing in Europe. I think, regulators, but also the politicians actually work very hard on that to really kind of loosen up these bans and making sure that, cost-efficient, simple to understand products are actually readily available, better available across Europe. I think it's a slow process. MiFID II was one attempt, also giving more transparency, making clear, what you actually pay for. I think, I would say this market in Europe in 5 years looks really different than today. That's my kind of expectation.
Great. All right. I don't know if that was someone's cell phone or if it was a message to me that I need to move on with the discussion here. We do have another polling question. So, and I think we had a Wi-Fi issue before that maybe prevented the possibility of polling. Oh, you've already been answering the polling question. Here it is, and I'll just put it to you again in case you haven't looked up at the screen here. What factor will drive the most asset growth in ETFs in the next 5 years? So we've got a couple of different factors to choose from. I kind of want to cover that up so you're not swayed by the results that you already see there. But innovative strategies is one factor. Focus on costs is another factor. And regulation, obviously, is a huge factor as well. When there's an election, like if there's a Turkish election, we're banned on television from talking, or even British election, we're banned from talking on television about the polls, usually in 24 to 48 hour periods beforehand, or even a week, depending on. So this is kind of unfair to leave this up here while we're doing it. But in any case, I can see, someone else is voting, so we're catching up here. If you haven't taken part, it's an interesting question. What factor will drive the most asset growth in ETFs in the next 5 years? Innovative strategies, focus on costs, or regulation? It's a pretty close horse race there as I watch the live polling. It couldn't really be much closer than that, could it? So I guess that proves that the question is pretty interesting, since not everybody can agree on an answer. I would think regulation is a huge one there. I mean, innovative strategies is interesting, focus on cost is important, but regulation, and people seem to live and die based on regulation, especially in this continent. In any case, I would lose if I had a bet on that. So thanks so much for your time. Really appreciate it. And I'm going to bring on the next panel. So Frank, Thomas, Carmen, thanks very much.